So welcome to Prerana Television Canada. On behalf of Global Academy of Holistic Leadership and Coaching, we are continuing our financial literacy speaker series, and we're very glad that we're having today episode 5. And today we'll be discussing about a topic which is very relevant for you, which is called insights of investing in home. So thank you very much those who are following with us. We are very happy that we're able to deliver you or we're able to share with you uh, the some of the relevant issues that is actually helping our community. Prerana Television Canada is actually based in Edmonton, Alberta, Canada, and also Global Academy of Holistic Leadership and Coaching is an institute federally registered, also registered in Ontario and is in Alberta. We are continuing delivering a number of speaker series. This is one of our 10 speaker series that we are continuing here. So we are very happy those who are following with us. As usual, our the series actually the financial literacy speaker series. We're having collaboration and with the help of Growth Space Financial Solutions. We're very happy that we're having a distinguished community member is with us. He's none other than Bishwajit Borua. He's a chartered professional accountant, CPA, and he's a financial consultant, and he's the owner of Growth Space Financial Solutions. Growth Space Financial Solutions is a company that provide investment, tax, and insurance and other financial solutions. And so we are very happy that Mr. Bishwajit Borua is with us, and he will be sharing with us the insight of investing in home. So I know that many of the community members will be interested to know. As usual, as you know, this community TV channel is a multilingual TV channel. So we'll be discussing first part mostly in English, because there are a lot of people all over the world. They are following with us in English, and the later part of it will be speaking in Bengali, which is Bangla, which is one of those major languages in India, and the main language in Bangladesh. So this will be sharing in the later part. Thank you very much, those who are following with us. And I now welcome Mr. Bishwajit Borua, CPA and financial consultant of Growth Space Financial Solutions. Thank you, Mr. Borua, for being with us. You can continue.
Thank you. Thank you, Dada. It's a pleasure to be here with you and it's an honor. I would like to just first introduce myself as usually. I'm Bishwajit Barua. My community people, especially from Bangladesh and India, those community people know me as Bishwajit, but out of my community, I'm known as Bish, the first four letters. I'm a chartered professional accountant and a practicing tax accountant. And financial consultant too. And these two things together make me a finanius, meaning financial genius. I'm a trainer and developer of future leaders for the financial industry. I provide financial confidence to individuals and families. And as a growth expert, I ensure faster financial progress of individuals and families by managing finances and tax together. I'm an expert in first generation immigrants who are individuals and families of 25 to 50-year-old, around that age range, uh, employed or self-employed, mid-income, and trying hard to realize their dreams, because I'm also one of you as first generation immigrant myself and have experience of managing self-employed people for over 25 years. I have exactly the same feelings and pain points as you do. That's why I understand you the best and possess the skills and expertise to develop and serve you. I can cut through the clutter, solve complex financial problems, and provide expert solutions to you for free. That's my introduction.
Thank you very much for sharing your introduction. Now we'll be discussing mostly today about insight of investing home. So I'd like to know, right, why we are discussing this topic now.
Okay.
Rather
That's
going
a,
to the details, just share with us the reason why we are discussing the topic right now.
That's a very good question. It's, when we invest in home, it could be primary residence that we live in or an investment property. There are lots of things happen that we don't really calculate those, figures, calculate those expenses or those numbers. And lots of time we don't even think about those things, but those things are there that are pinching our pocket in some way. And we need to see those things and we need to feel those pinches. So as a financial professional, what I would like to do is point out those things so that everyone is aware of those things. And when they're deciding, they get a better perspective from all different corners so that they understand, okay, there are some issues that we don't usually think, but those parameters, those aspects are also there that we need to consider. And if we consider, it's going to be a better discussion. Here, I just want to note one thing, that I'm not really providing any sort of suggestion or consultation here. I'm just providing some insights. The reason I'm providing this note of caution to everyone is everybody's financial goals and situations are totally different. So the decisions that we take for buying home should be very unique to individual and family. So depending on individuals' goals and situations, things will vary. That's why I'm not suggesting, rather I would say that take these insights, think about it, then if you need to, talk to a financial professional and then make up your mind, especially for the investment side, not for the principal residence or for our home that we live in. That's a totally different thing, because we are emotionally connected with those decisions. It's not only all the time the calculations of how money is going to be out of our pocket. It's a lot more than that. It's lots of dreams, lots of emotions are connected with those. So we need to consider those things too. So that's why I'm providing the insights, not providing any consultation. So that's the thing I would like to provide a caveat on that.
All right, thank you very much. Now we'll discussing about right that about the investing of home, right? So what are the basics that if you want to invest in a home, what are the basic informations or considerations
Okay.
that you have to have in mind before even going for investing?
Let's divide our today's discussion in two different parts. On the first part, we'll discuss about our primary residence where we live. So that's going to be on one hand, we will start with that. And on the second part, we'll discuss about our investment property. Lots of us, think about making another property where we can build up our equity and hopefully in our retirement time that provides us some source of income. That's an investment property. So we'll discuss that on the second part. Now, just to make sure that if someone wants to note down something or wants to take a picture, I would like to share my screen with you.
Okay. Just yeah, you can go ahead.
Okay. So I told you, I gave you my introduction, and most of the time, people always talks about indirectly. And in our community, we don't even talk about money making, how much we make. We don't talk about in public or even in outside of family members. We don't discuss about making money. But I'm a professional who helps people in making money, and we are educated on making money indirectly, not directly even. And the second aspect, which is most important thing, that is managing money. We are not given any education in any institutions, high school, colleges, universities, doesn't matter it's Bangladesh, India, or Canada, or any part of the world, we are not given any education on how to manage our money. But that's very important. And the discussions that I'm going to have is a little bit different because of my professional education and professional experiences and diversified experiences. It's going to be a little different. And it's not going to exactly match with what other 10 common people are always talking about. So it's going to be a little different. I just wanted to give you a caveat on that one too. So when we talk about having home ownership, there are obviously some advantages, and let's start with the advantages. First thing is, it's our dream. And when we start our life in Canada, even before from that time, when we start migrating, in fact, we think about migrating, always we think about that we will go to Canada and we will have our own home, we will have our own car and own lifestyle. So from that perspective, having a home is in our dream, and lots of emotions are also involved in that. So it's not only and the biggest investment in our life, it's lots of emotions and dreams are also connected with those decisions. Now, the first thing comes is, it provides us shelter. That's what we want. It provides us shelter. But one thing is for sure, it doesn't provide us any sort of income. Why? Thinking about income is important. Most of the time we are paying, say, like 5 to 20% down payment. Most of the times, more than 80% situations, it's 5% to 20% down payment, which means we are basically taking a loan of 80 to 95%. So we are mostly buying loans, and it's banks or mortgage companies' property we are living in, we are paying every month. We are just living in, and they have the lien. Banks or mortgage companies have the lien. So the mortgage we are buying is a very high proportionate. Even if we think that we are paying 20% down payment, the reality is we are buying 80% of the mortgage. And if anything goes wrong with our income, which might happen, lots of families are having financial disaster just because of loss of income. We need to make sure that you need to be aware that this might happen in anybody's life because of sickness, because of untimely pass away situation. Unfortunately, this happens. So the key thing for planning parties, we need to protect our income, or we need to protect our home, so that our loved ones, our spouses and kids, they don't need to go on the street after I pass away. So it's the mortgage that we have. We need to protect that so that our house is there. So that is the strategy part, that we need to ensure that we protect our home, the big mortgage. Now, interest rate, it's a very good time that we are passing on. Those mortgage rates have started going up. So people who are thinking about buying their homes, first home especially, go for it. This is the right time. Buy, because house prices are quite reasonable for the economic situation, and interest rates are also quite low, historically low. So go for purchasing it. Now, why the interest rates are always lower out of all the loan opportunities that we have always? Because banks are having the lien on that. I told you, banks are having the lien. If anything goes wrong, we can't pay the mortgage, banks will come and take our property because they have the more majority share of our home. So they will come. And because of that lien, comparing to any other loan that are available in our economy, mortgage rates are quite low. And another advantage, we always keep that in mind, that, and everyone says that value will go up, and true. In the long run, the house prices will go up, and we would like to take advantage of that. House prices will go up. But here again, I want to give you another thought that uh, if we are paying our home loans back within, say, about 25 or 20 to 30 years, sometime around that range, within that time, we pay almost another similar amount of principal amount in terms of interest. Say you have a home of mortgage $400,000. So in about 25 years, you pay another $350 to $400 in interest. So when we calculate the appreciations, we think, oh, I bought the property for $500,000. I'm selling it for 1.5 million. We tend to forget that another $500,000 probably we paid in interest. So we need to calculate that too. Sometimes we miss that part. So I'm just giving you a food for thought that yes, we pay another amount for interest, same amount of the house price as interest. Now, if anything goes wrong, we might experience the depreciation as well. So appreciation is when the price is going up, we can take benefit out of the capital gain. But sometimes the price goes down too. Like probably right now, even in Edmonton, we are experiencing house prices, say 5-6 years, just like me, 5-6 years back when I bought the house in 2013-14, at that time, house prices were quite high. Now, if I'm selling my house, I lose my money. I'm not going to get everything that I have invested in. So sometimes house prices also depreciates. And capital gain, I already discussed that capital gain is there, but interests have to be calculated too. So along with our emotional bondage with our primary residence and the dreams, keep those things in mind too. Now, let's move on to the disadvantages. This is very important. Lots of time we don't really discuss these things. When purchasing the homes, land transfer fee is there, which is on an average about $5,000 cost. So we need to get ready with that expense. Realtor commissions, we feel that when we are buying, we are not paying the realtor commissions ourselves. But the reality is everything is paid by the buyer. Even though the seller is paying directly the realtor commissions, it's really paid up by the buyer indeed. And the legal fees, it's about $1,000 on an average. So 5,000 for land transfer fee and another 1,000, total is $6,000 that we have cost. We need to keep that in mind when we are thinking about our 5% or 20% down payment. We need to calculate those fees as well. Now, ongoing costs are there. We know we calculate, but probably sometimes we miss some aspects. Here I tried to cover all those points. Property tax, every month we need to pay the property tax, and it's going up. Property tax goes up for different reasons. Like say right now, property taxes, even in Edmonton, going up because municipal governments key income source is property tax. When you know that governments are in financial pressure because of COVID-19 and economic situations, they would like to get their money from some source. And property tax is a very key source of income for municipal government. So they keep on increasing property taxes with some complex formulas. So property tax increasing few $1,000, $4,000, $5,000, $6,000, depending on the size of the land and depending on the size of the house, the property tax is calculated. Utility bills, all we know and we calculate. So I don't need to worry about that thing. You know that utility bills are like water, electricity, and gas bill. So these are the three utility bills. If you are owning a condo, then condo fees, monthly fees, that are an expense. It's not adding any value to your property unless you go through a major renovation externally, not even internally, externally, then condo fee covers that, but we have to pay condo fees. And the more your property is growing older, the more condo fees you pay. Don't forget that. You bought a new condo, you pay less, but with the life, growing older for your condo, you pay more condo fees. Association fees, residential associations. Lots of times we have residential associations, we pay a few $100, like anywhere between 300 to 500 or 600, like Summerside we have, or even Orchard we have association fees every year. These are not recoverable. Every month, home insurance is another part. We can't really get the key of the home after buying the home if we don't make sure that we have home insurance. So that's important, and it's imposed by the mortgage company. If we have any sort of rental income, say basement we are renting out, that income, if you have a net income from renting the basement property or any part of our property, we have to pay taxes on the rental income, and it's at marginal rate. Say if your marginal tax rate is, say if you are making say 80, 90, 100,000, your marginal tax rate is about 30.5% in Alberta. So at marginal tax rate, if you are making say $5,000 rental income after deducting all expenses, then that on that $5,000 we need to pay 30% taxes, income taxes. So we need to calculate that. We don't really sometimes think about those things, that we need to pay taxes. We need to consider that too. Now, when your house is growing older, you need to pay more and more maintenance costs, and some maintenance costs are quite high. Like say, if you need to change your roof, which takes about 15, 20 or about 20 years, you need to change your roof. It's quite expensive to change the roofs. So, and furnace, quite expensive. Those things are their maintenance cost. Every few years, you need to make sure that you are cleaning your carpet, you are cleaning your ducts, those kind of things, along with other maintenance costs like your washroom things, your kitchen things. You need to make sure that these things are, upgraded, or if these things are not working, you need to replace those using some professionals. So need to make sure that we are considering our maintenance costs, especially when we are buying an old property. For new property, probably 5, 7, 8 years, we don't need to worry much. But for old properties, we have high maintenance costs. Now, I told you that we have quite a bit of mortgage for most of our families. 80, 90% families, we have 70, 80% mortgages. Now, if anything goes wrong with the income uncertainties, we need to make sure that we are protecting the mortgage so that our families don't need to go on a street. So protect that. You make sure that you have a life insurance so that your income is replaced and your family, in your unfortunate absence, can take care of that. Now, the other three things, most of the time, we don't really care about these things. Liquidity risk. If you are in emergency situation for any reason, God forbid, you need to sell the house quickly. You can't pay your mortgage right now. Anything goes wrong with your income. We need to sell the house. The more time we are keeping or we are paying the mortgage bills, we don't know where the money will come from. Probably line of credit, credit card, who knows, right? Hopefully no one faces that situation, but it might come. So if we are in pressure, if we are in time pressure to sell our house, liquidity risk is coming up because immediately we can't sell the house. That's the liquidity risk we call. Liquidity risk, we can't sell the house immediately. If we would like to sell the house right away, we need to reduce the prices. So the equity that we have built, that equity is coming down. Or we might make some losses. Losses could be losses from profits even. Say appreciation you got, but that appreciation is reducing because you are in liquidity risk. Market risk is another aspect that we need to be aware of, that for some reason, say housing market or real estate market is not going well. For different reasons, it might happen. Say, government has increased their prime rate, so your mortgage rate is going up. What will happen? Not enough people will buy the home. So probably more than enough, or the supply of the houses are more. Demand is less because less people are qualifying for the home for different mortgage rule changes. So housing market in general might suffer. That's the market risk. So if you are trying to sell the home, that might take longer time, which means you don't want to continue probably, but you need to continue because of the market risk, and then you suffer a little bit of loss. So keep that in mind. Interest rate risk is another thing. Right now, interest rate is quite low. Probably, hopefully, that will continue for next few years. But it might happen that interest rates are going up. Now, the question is, say, right now you are getting 2% or 3%. You can afford so much. But if interest rates are going up like 4, 5, 6%, you have to pay more. Now, our income is not increasing in that direction, right? Not at that pace, at least. So that growing interest rate, either we have to adjust by increasing our amortization period, which is in how many years you are paying off your home. So that has to be up, like say instead of 20 years or 25 years, it has to be 30, 35 years, which means we might be retiring even before paying off our homes, even worse situation. So interest rate, especially when it's going up, that's posing us some risks. We need to consider that. Now let's move ahead in our life. Say we have enjoyed our life and we passed away. We all will die, and at some point in time, all our assets, we expect that it will pass to our kids, our next generations. Now, in Canadian rule, all the assets that we have, especially the real estate, there is no way that you can avoid it other than that you are planning well in advance. I'll talk about that in a little bit later part. So if we pass away, all our assets and liabilities goes through a probate process. What probate process is, say all my assets and liabilities will go to first of all, say Bishwajit's estate. And probate process it's a legal process run by the provincial government. And first of all, government will come because ownership is changing from me to my kids. And whenever any ownership change is there is tax implications. Government will get taxes because those assets are going from my hand to my kids' hand. And that year that I'm passing away, my kids will have the total assets as their income. Ownership change, it's treated as income. So whenever it's income for them, that year they'll have to pay taxes. Say I bought a home for $500,000, $500,000, and after 20 years, I'm passing away, or 30 years, I'm passing away, the price is now $1.5 million. So $1.5 million value, market value, my house price is $1.5 million. And at that time, my house ownership is going to my kids. So $1.5 million will be treated as income for my kid. And my kids has to pay taxes on $1.5 million. Now the challenge is they don't have that cash. Nobody has that cash. So if you can plan well in advance that this is going to happen, I can make sure that I can buy an insurance considering calculating everything and make sure that I have an insurance proceeds, which is tax-free. Insurance proceeds are tax-free. Get the money and pay off your kids can pay off all the taxes. So government tax, which is 50% marginal tax rate, for sure $1.5 million, $750,000 in our example, they'll have to pay tax. No other options. If they need to, they have to sell the property and then pay the tax, and then you go ahead or make a plan with CRA to pay your taxes. Now, probate process, government will come, will get the tax. And then your all creditors will come. Hopefully we don't have any mortgage by that time. But if we have any mortgage or any other creditors like line of credit, any business loan, any personal loan, those creditors will come and take money from that too. So taxes gone, creditors are gone. Then the probate fees. Probate process is provincial legal process, and provincial government will come and will take a certain percentage of your whole property. It could be quite a bit of money, depending on how much is your asset worth. So that will take, you never know, $20,000, $30,000, $50,000, depending on how much your asset worth. So that's probate fees are there. So we need to plan for that. Otherwise, we wouldn't know even after we passed away, we wouldn't know anything. We are above everything now. And our kids are suffering because I didn't plan everything accordingly. So we need to make sure that probate process and all the costs related to that, we are providing that money to our kids. Otherwise, they are not getting the full asset. Creditor claims we discussed, wealth transfer tax we discussed. Now, when these things we need to keep in mind and plan everything. So major two things of planning I discussed. One is if I'm passing away in an untimely manner, I need to make sure that I'm protecting my property by doing an insurance. Second thing is when the wealth is getting transferred to our next generation, need to make sure that the tax money, again, I'm putting in some insurance so that insurance proceeds after my death helps my kids to pay off that tax, and then they can enjoy the property. Otherwise, they won't be enjoying any property too. But for calculating all these things, talk to a financial professional. And I told you many times that I'm a financial consultant and I provide all this consultancy for free anytime. The number is there. You can talk to me, and all the consultations you get for free. Now, when I'm talking about all these major things that people usually don't even know in some cases, when we think about investment property, the things get more complicated, because investment property means we are buying more loans, at least 80% more loans for our investment property, with an expectation that we will have some rental income and our renters will pay our mortgages. It's there, but we are buying more loans. That's the very critical thing we need to consider. Edward, any question coming up? I should move. Okay.
Yes. So question, there is no question yet.
Yeah. Yeah.
Yeah. We'll be going at the list. You continue and I will get back to you.
Okay. Okay.
Thank you.
Thank you. Now moving on to the investment property, we need to make a little attention. We need to make sure that we are paying little more attention here, because I'm going to compare two situations here. One, I would say that it's a smart investment, and the second one is a second home mortgage. Which one would be better? Now, while discussing that, so giving you two options. One is I'm going to buy, like all my friends are discussing about, buy second property, why I should buy second property, how and what are the things we need to consider. And at the same time, I'll provide you another scenario that money, what you are planning to make down payment in the second investment, let's say that it's a smart investment for now, and you will decide finally if it's a smart investment or not. So smart investment, second option. Now, so what we want is, from second property, our renters will pay the principals over a period of time, and the value will appreciate, and I'll make money. That's what everybody is thinking. But there is a very critical thought process that lots of people think that what 90% or 95% common people don't do that, because common people are mostly making mistakes. So now I'm providing the information. Decision is up to you. And if you need my consultation, of course, you can consult with me anytime. Now, when I'm comparing these two situations, the smart investment and your second property investment, these two things, I'm going to discuss it in 4 different phases. One is before purchase, what happens? One is during the purchase, what are the activities we do and what happens with us? And after purchasing our investment property, what happens? And succession. You got a little bit idea. And succession, what happens with our property when we hand over that property to our next generation. So we'll discuss in 4 different distinct phases. Let's move ahead and start with the pre-purchase. Here you see, on my slides, there are 2 different colors I have used. On the left-hand side, I have used the home, and the red means we need to think about it. And the blue means it's good, we don't need to worry about it much. So let's go ahead and discuss. Pre-purchase, house hunting. That takes lots of time. We don't think that, yeah, it's good. It's good in a sense that you are physically active, you are mentally active, but it's an stress too. House hunting it takes lots of time. That time you can use for developing your skills, which is very important in this modern economy, especially this time of digitalization age. It's very important that we develop our skills. We can use that time to develop skills instead of house hunting. Inspection. We need to find out an inspector and need to make sure that they are not only, say, taking $500. That's what his average inspection cost is. For inspection, sometimes they just do a job. They don't really pay enough attention. But after purchasing home, you see that lots of things are coming out, which inspector never really discussed with you. So need to worry about those aspects plus the inspection cost. Need to arrange the mortgage. For second property, first thing is probably most of the people who are investing in second home mortgage, they know that I need to make sure at least 20% down payment I am making. But for rest 80%, we need to make sure that we are arranging mortgage. Sometimes it's stressful too, because you would like to get low interest. It's your second property. Mortgages are a little higher because bank is taking more responsibility and more risk for you. You need to search the lawyer and pay the lawyer again, another $1,000 probably on an average. And realtor commission. So you pay for that. So you see that there are lots of time wastage from our part when we buy the second property and lots of stress related to their different activities. And thousands of dollars are expenses, thousands of dollars. Whereas if we think about right-hand side, smart investment, I'm slowly going into introducing that concept, but with the smart investment, you don't have any expenses and you don't have any stress. No expense and no stress. You just relax. Keep the money in your pocket. Your money, instead of paying down payment, keep it in your account. And if you want to make money, talk to a financial professional. From your money, you can make money all the time. And if you are not making money, you are losing money. So you should make money and more than inflation rate. So there is no expense and stress. Just relax. Keep your money in your bank account. Let it make money for you. Pre-purchase situation. During the purchase situation, what you are doing? 20% down payment, which means you are buying 80% loan. I told you before, you are buying 80% loan. You are paying realtor commission. You are paying land transfer fee, which is about $5,000–6,000. You are paying legal fee, which is about $1,000. So thousands of dollars are going away. It's your hard-earned money, your savings. Suddenly you are losing all those savings. Yes, you are building up another property probably, but for any emergency reason, if you need cash, you are losing that cash. Don't forget that you are losing that cash and you are buying huge loan, 80%. And this time when you purchase, the expenses are not in thousands. It's tens of thousands you are spending. Whereas on the other side, a smart investment, you don't need to make any down payment. Since you are not buying a home, you don't have any loan even. You are not purchasing any 80% loan. You are not paying any commission because you are not buying any home. You are not paying any sorts of fee, land transfer fee, legal fee, you don't pay anything. Let's say what you are doing is you are paying say $200,000 down payment. I'm giving an example of Toronto, say. And if it is in Edmonton, the proportionately everything comes down. Toronto or BC, if you are buying a home, you hardly get anything for less than $1 million. So $200,000, you need to make sure that you have down payment. Or if you are buying in Alberta or any other places, probably $500,000. So your cost will be, or your savings will be $1,000. Instead of paying cost, you save $1,000 every month from one saving account to another saving account for 15 or 20 years. So your down payment money, it's in savings account or invested. Take that money and slowly invest in another investment account, which is a smart investment for 15 years or 20 years. Depending on your situation, we can plan that thing. So during the purchase, you see on the left-hand side, second home, it's all red. But on the right-hand side, smart investment, it's all good thing. You are keeping your money, and from one investment account, it's slowly money is going to another investment account where you can make a lot more money even. Post-purchase situation. You pay mortgages, 80% mortgages, and over a period of about 25 years, you are paying double the payment. And you pay property taxes, you pay your home insurance, you pay probably utility bills too. If your renter is paying, you don't need to worry about utility bills, but insurance probably. You need to consider the maintenance cost as well. Rental income is a good thing. That's why we buy. But remember one thing, for 12 months, for all the years, 5, 10, 15, 20 years, you might not have the rental income. Sometimes if the tenant is going away, it's difficult to get another tenant. Need to calculate that I'm not earning my rental income, and I need to calculate those things too. And if I'm having rental income, I need to pay taxes on that rental income at the marginal tax rate, which is on the higher side. For people like people who are making $80,000, $100,000, you're paying 30% taxes on that too. So your real income is coming down. Now, on the other side, you don't have to pay any mortgage payment because you are not buying any loan. Smart investment. Rather, you are saving from your investment account, you are saving $1,000 every month in another investment account. You don't have to pay any interest. There you are paying, if you are paying, say, if you are getting $500,000 mortgage, you are paying another $450,000 to $500,000 in interest. Here you are not paying any interest, rather you are earning some money. It could be depending on your investment. You can make interest, or you can make dividend income, you can make capital gain income. So these are the advantages with a smart investment. You don't have to pay any taxes, bills, any fees. With your home, you are paying lots of bills, thousands of dollars every year in bills, fees, and taxes. Rather, you make dividend income for your rest of your life. Dividend income, where you pay less interest, less income tax. Dividend income is at least 60% less tax you pay. So post-purchase, only rental income is the positive thing. The rest all are the things that we need to think about, calculate. On the other side, everything is positive for a smart investment. Succession planning. Think about the situation I told you on the primary residence. When we are buying another home, which means we are buying another mortgage, which means we are increasing our debts. If anything goes wrong, what will happen? If I'm passing away untimely, what will happen? The asset is gone. The equity that you build up, probably most of it is gone. And your income is also gone. So to manage that death risk or any uncertainties with respect to income, we need to make sure that we have insurance for, and we are covered for all the mortgages so that we don't need to worry about it. Appreciation could be there. Of course, that is one of the major considerations that we have. And that's why we got it. But depreciation could be there too, depending on the timing. We need to keep that in mind too. Hopefully not, but in the long run, value will go up, but you never know in the short run what might happen. The thing is, you need to plan ahead and protect it. For second property, it's a commercial property, rental property. You need to pay taxes on capital gain. Your house prices are going up, so you need to pay taxes on your capital gain. You pay 50% taxes, or in another word, I would say, you pay taxes on 50% of your capital gain. 50% of capital gain is taxable. So need to make sure that one. I explained probate fees. Probate fees you need to pay. Creditor will come and take the money from you, including the mortgage company. Creditors will come and they have the right before our next generation or our beneficiary or our successors. Creditors have first priority, not our family members. Wealth transfer tax, I explained to you. This is even more difficult because this is second property. So your wealth transfer tax, it's an extra burden for your kids. Liquidity risk, I discussed. If I'm passing away, I can't really sell the property right away. If I'm trying to do that, instead of taking 6 months, if I'm trying to sell it in 3 months or 2 months, the price has to come down until somebody is buying my house. So liquidity risk is even getting worse. Whereas for the smart investment, death benefit will be there from day one. I'll give you an example on my next slide. Death benefit from day one. So instead of paying for it or having, this is giving you and your family some money so that you don't need to worry about it. And you enjoy a guaranteed growth of your cash and death benefit. Your death benefit will increase, your cash benefit will increase over a period of time. If you don't pass away, your cash benefit will increase from the investment income and your death benefit will also increase. And whatever you are making from the smart investment, you don't have to pay any taxes. Whereas on the left-hand side, from second home investment, you are paying taxes. Here, you don't have to pay any taxes on the growth that you are enjoying. And creditor protection is there. There on the house, creditors will come and take the money. Whereas with the smart investment, it's creditor protected. Creditors can't touch a single penny out of that. And your kids will get the wealth on a tax-free basis. Here you are paying 50% taxes, whereas on the smart investment, you don't have to pay a single penny tax. And from that investment, you enjoy a retirement income, which is way more than the rental income even, way more than rental income. And there is a tax planning technique that you can apply and enjoy that retirement income without paying any tax. Whereas rental income, you pay taxes at marginal tax rate. If you need the liquid cash for any reason, you can't take the money out of your home. You need to sell the home and problems are there, challenges are there. But if you need any emergency fund or collateral loan, you can take the money anytime, any amount you want, within certain limit, because it depends on how much you are putting in, right? Let's go to an example of that in smart investment now. With a smart investment, what we are doing, for example, 45-year-old male and non-smoker. Every single parameter is important here. Saving $1,000 per month for 20 years. So total savings would be $240,000. $1,000 you are putting in every month. So in a year, $12,000 for 20 years, it's $240,000. Now, comparing to buying home, what we are doing, if you are buying $1 million home, we are paying 20% down payment, which is $200,000. Here, keep that $200,000 and pay every month $1,000. So that $1,000 investment from one account to another investment it's going to. What are the benefits? So from day one, protection benefit is $350,000. Now, here I must mention one thing. If you are younger than 45-year-old, your coverages will be better. you from day one, protection benefit will be higher depending on your age. If you are older, protection benefit will be lower. So with your younger age, protection benefit will be higher. With your older age, your benefit will be lower. When you are investing this, after when you reach 65, you paid for 20 years. So at 65, you reached your retirement age. And at retirement age, now it's the time I need some retirement income from my investment. Let's say in our example here, we are taking out $20,000 every year and for 20 years. You can decide what amount you want. But in my example, I'm giving you that $20,000 with other income, retirement incomes. I'm taking from my investment $20,000 every year for 20 years. So 20 years is $400,000 I'm getting. And there is guaranteed growth of the cash. Cash value, I can take about $300,000 after even taking this one at 85. So 65, 20 years, 85. I have taken $400,000. Another $300,000 is also there. How much I put in? 240. I didn't buy any loan. Another emergency fund, if I need, the tax-free is there. Emergency fund I can take tax-free. Tax planning is needed for that. I'm not going into the details of that, but it's possible. Now, when I'm transferring the wealth, with smart property or with the second home investment, sorry, my apologies. With the second investment home, I need to pay taxes. Whereas here, I don't need to pay any taxes. And whole asset will go to my next generation or my beneficiaries, successors, without paying any single penny tax. So at 50% marginal tax rate at that time, $400,000 benefit is equal to $800,000 pre-tax benefit. So if I'm trying to apple comparison. Now, so the total benefit is coming. Retirement income in 20 years, I got for $400,000. Cash value is there. Even after taking $400,000, another cash available, it's about $300,000 plus. And when I'm passing away, say at 85, for example, there is another $400,000 going to my next generation tax-free. And if we consider the pre-tax money, it's equivalent to $800,000. So 400, 300, and $800,000. Total is how much? $1.2 million? No, 300, 700, and 800. More than that. So tax-free total value is here 1.2 plus, if we consider another $400,000, we can add that too. So it's quite a bit of money that we are talking about, tax-free. For getting that tax-free money to our next generation, it's equivalent to $2.4 million. So you are investing this $200,000 or $240,000 and getting a benefit of like $2.4 million, and tax-free is to $1.2 million. That's the advantage I'm talking about on smart investment. Without buying the second home, invest that money in another smart investment. If anyone is interested to know, you don't need to decide anything. If anyone is interested to know what is that before you decide for a second home, get in touch with me. I'll take time to explain you everything. Then all of you are adults. You decide in your way, understanding your financial goals and understanding your overall financial situation. We can take care of that. Now I'm done up to this point here on the home, second home investment, or
Yes, thank you very much. I think there's a good session. Today we won't go to that the other linguists first part because you already covered in our, so good. We don't want to prolong your session. We have promised for some of the I think question here last time that we'll be answering some questions. So I would actually request you to at least answer the question that we promised. to
Okay. There
deliver it.
was one question last time that vehicle expenses, employment expenses for vehicles, or what are the expenses we can claim? I think it was Novelvai or someone, right? If
Yes.
I am not wrong. So I hope Novelvai is there to get that information. But anyway, the information will be recorded. So I'm going to share again just to make sure that it's there for people who would like to take a snapshot of that. Okay. Claimable motor vehicle expenses for employees or who are making commission income. So there are 7 expenses that we can claim. In fact, there is nothing that we can't claim. So just to make sure that everyone is clear, I put everything here. All fuel expenses, maintenance and repair costs, insurance expenses, license and registration, capital cost allowance. This is and in another word, in common language, we say depreciation. Capital cost allowance is the CRA or the tax language, and common language, accounting language is depreciation. Some interest expenses, there are some rules, but some interest expenses we can deduct. Leasing cost, if somebody is leasing the vehicle for employment purposes, usage of the vehicle, leasing cost also can be deductible. But we need to make sure that there are some preconditions we are meeting. First thing is our employer is giving us a T2200 form, which is employment expenses. T200 form, and there lots of things will be there. Our employer must have mentioned that for job purposes, the employee is allowed to use their personal vehicle. Only then we can claim all those expenses. Now, not all expenses we can claim. There is the catch. Now, I'm driving, say, 20,000 kilometers. Out of that, I'm driving, say, 8,000 kilometers for my work and 12,000 kilometers for my personal usage. So it's proportionately we can claim. In our example, it's 8 and 12. 8,000 is employment purpose and 12,000 is personal purposes. So 40% of the expenses of all these expenses, 40% we can claim, or the mileage proportionate. Here we need to point out one thing, that we need to maintain a logbook, vehicle logbook for all employment mileages, not for personal one. Personal one, nobody really would like to know about where we are going, but for employment purposes or business purposes, we need to maintain a logbook that on this particular day, I'm traveling from this place to that place, and this is the kilometer. And on a daily basis, we need to maintain that logbook so that when CRA is coming for an audit, we can provide that. So maintaining that logbook is very important. If anyone needs help, just let me know. Email me or text me. I can provide you the simple logbook so that you can maintain that logbook on a daily basis. And if you are using multiple vehicle, even for any reason, for multiple vehicles, we can use the same calculations. Proportionately, for employment usage and personal usage, we can claim all those. So those are all the expenses and preconditions and requirements. And to be on the safer side, we need to make sure that vehicle logbooks are maintained.
All right. Thank you. Thank you very much. Yes, thank you very much for your time. I think we don't have any other questions, if I think so. But I guess there are a few others probably will reach us through email or other media, and we'll address those one in our next session. So thank you very much. Those who are following with us, Prerana TV, in collaboration of Global Academy of Holistic Leadership and Coaching, and within collaboration of Growth Space Financial Solutions. We're very happy that we completed our financial literacy speaker series episode 5, and we are inviting you for our next session, which will held next week, same time. So please follow us, and if you have any questions, you can reach us in our social media, or you can email us at info@prerana.tv, or You can contact us, contact at ghlc.ca. And I would like to thank you again for following with us, and stay safe and stay blessed. Thank you.
Thank you so much.
Thank you.